If you've used up your ISA and your SIPP allowance in a given tax year, then buying single UK government bonds is a very tax efficient way to invest. So in this video, we'll look at those tax efficiencies and we'll also consider some tools which can help you choose the gilts which are right for you. Now, if you do enjoy our content, please do like this video and subscribe to our channel. So let's look at why investing in government bonds is great in a bit more detail. I think there are 4 reasons why you might be interested in buying single UK government bonds. The first one is that tax efficiency, which we'll dive into later on. But I think the second one is also relevant for many investors, and that's if you've received a big lump sum and you want to park that capital somewhere while you drip feed it into the stock market or other investments, and you don't want to take a big capital risk while you park it, then again, this could be a very tax efficient way of earning some income, but also parking it somewhere safely without the risk of a big capital loss. Another reason might be that you know you're going to have a big expense at some point in future at a known date, and it's a known amount. So for example, it could be a wedding, it could be one of your children's going to university, whatever the expenditure, because you know to the penny how much you're going to receive with a government bond on the day that you buy it, and you also know what return you're going to get. They provide brilliant cash flow planning tools. Now, this isn't for long-term investing, it's just for the short to medium term. And then finally, if you're a bit bloody minded, then it's great to have the government pay you money for a change rather than you having to pay them. Now, the reason why we're talking about this at all is that yields are now higher. If you look at UK 1-year, 3-year and 5-year gilt yields, you don't have to go very far back to see yields which were actually negative. In other words, if you'd have bought one of those bonds with a negative yield, you'd have definitely locked in a loss. Well, the world now is very different. Across the entire yield curve, you've got yields of above 4%, and at the short end of the curve, as you can see, the yields are above 5%. So what does that 5% yield mean? Well, yield is actually short for yield to maturity. It's how much return you'll get on a UK government bond, for example, if you buy it today and just hold it until it matures. You never have to sell it, you just receive the face value back on the maturity date. And that means you also save on the trading costs because you only have to buy it, you never have to sell it. And it's always nice to keep money out of the hands of brokers. And as with any investment, the return on the investment can be broken into 2 components. One is the income you receive while holding the investment, which in the case of a government bond is called the coupon. And the other component is the capital gain. You buy at a low price and hopefully sell at a higher price. Add those 2 together and you get the total return. And in the case of a government bond, that's roughly equal to the yield to maturity. So let's look at an example where you buy a bond today for £96. Now the coupon on the bond is 1%. So that means that in 1 year's time, you'll receive 1% of the face value of the bond which you bought, which is about £1. And because this is a 1-year bond, say, you'll also receive the principal back, which is 100. So you bought £100 for £96, so that means you've got a 4% capital gain plus income of 1%. So the total return is 4% plus 1%, which is 5%, and that's our yield to maturity. But as we saw, any 1-year government bond would have given that same yield, but different bonds will have a different breakdown into capital gain and income. So let's say we've got another bond which is trading at £100 today. Well, the income on that bond is 5%. So in this case, all of our capital gain amounts to 0. We have no capital gain. All of our return comes from the income component. So we buy at 100 today, we receive 100 when it matures in a year's time, and we also receive a 5% coupon, which is £5. So our total return again is 5%, but it's composed differently. And as we'll see later, that composition is really important when it comes to tax treatment. Because the beauty of UK gilts is that you don't pay capital gains tax. So if you go to the HMRC's website, you can actually see a list of UK gilts which don't incur capital gains tax. Now this is almost all gilts. I haven't found one yet which isn't on that list, but it's probably a good idea to check if you are about to buy a gilt. But the entire list is there on that website. just Google gilt edge securities exempt from capital gains tax. However, the income you receive, the coupon on government bonds, is liable for tax up to some kind of allowance. Now, the precise allowance which you've got will depend on your tax band. So basic rate taxpayers will have a personal savings allowance, as it's called, of £1,000. And this is for the tax year 2023-2024. It may change in future. Higher rate taxpayers will have a smaller personal savings allowance of just £500, and additional rate taxpayers don't have any allowance at all. So any coupon income you receive on your gilts, which are held outside an ISA or a SIPP, which are in excess of your allowance, you'll have to declare as income. And this is part of your self-assessment. So now let's look at the UK yield curve to see what it looks like right now. So what is the yield curve? Well, we plot the time to maturity of each bond, in this case issued by the UK government, and that time to maturity goes on the x-axis, and we've got all periods from 0 years up to 50 years on this graph. And then on the y-axis, we plot the yield to maturity. Remember, that's our total return, which is composed of income return, coupon income, plus capital gain. Notice at the moment that the whole yield curve is inverted, such that short-term government bonds give a higher yield than long-term government bonds. And this is quite unusual. What it means is you're being paid to take lower duration risk because longer dated government bonds have much more volatile prices. Short-term government bonds usually have very low volatility. The prices don't wiggle much. They have lower risk. But in this topsy-turvy inverted yield market, which we've got right now, you're being paid more to buy those safe government bonds than the riskier government bonds. Now, what are the symbols on this graph? Well, usually there's a kind of ticker that goes with each government bond. So you can see TY25 has the highest yield of all at the moment. But if we were to plot the yield curve tomorrow, or even from minute to minute, it's going to change shape as the prices adjust for the bonds and as the yields change. And as I'm sure you know, if the price of a bond goes up, then the yield goes down and vice versa. So the two move in opposite directions. So if you're going to be buying single government bonds outside an ISA or a SIPP, then which ones are most tax efficient? Well, it's the low coupon bonds. So if we zoom into the yield curve for maturities of up to 5 years, I'm going to focus on just two bonds. The first one is TN25. Its longer name is it's the 0.25% of 25. This matures in 2025. And the other one is TR25, and that's the 5% of 2025. Notice that one of them is below the yield curve. It has a slightly lower yield than usual, and the other one is slightly above. But both of them have roughly the same yield because they've got roughly the same maturity date. However, the tax efficiency of the two bonds is very different if they're held outside an ISA or a SIPP. And that's because of the composition of the yield to maturity. Both have a yield of about 5%, but notice that TN25 is trading, as I make this video, at £94, whereas TR25 is trading at 100. That means that TN25 is going to have quite a big capital gain. In fact, the capital gain makes up almost all of the total return of the bond. It makes up 4.7% of the 5%. Whereas for TR25, we'll buy it at £100, but when it matures, it'll be worth 100 again. So there's no capital gain at all. That means all of our total return comes from income, which is taxable. So TR25 is much less tax efficient. Now, for people who have a premium membership on our website, we've got this tracker, which I think is quite useful when you're choosing your gilt. We try to update it every day, but it is just that yield curve that you saw previously. However, notice that some of the bonds which are shown here have a bigger icon, a bigger circle representing them. And that's because those are more tax efficient. So let's zoom in on the 0 to 5 year part of the curve. And let's look at those two bonds. Here's TR25. You can see that the income yield on that is about 5%, but the capital gain yield is just 0.02%. So this one, not very tax efficient. Most of the return is coming from income, which is taxable. But if we scoot down to this bond, which is TN25, notice the income yield is 0.3% and the capital gain yield is about 4.7%. And that's why the symbol for that one is larger than it is for TR25. So if we zoom out again, you can see how this tool is useful. Once you've chosen your maturity date for the bond you're interested in, you can see which bonds are much more tax efficient. And that's because more of their return is made up by capital gain. Now, so far I've been assuming that you're investing outside an ISA or a SIPP. However, if you're buying UK government bonds, single government bonds, inside an ISA or a SIPP, you can simply go for yield. So you're probably wondering why some of these gilts have a yield which is above the average for their maturity. Well, these are unloved bonds. For some reason, people don't want to buy them. And often you find that these unloved bonds are the ones which aren't tax efficient. That's because lots of people are now buying these bonds because they are tax efficient. And these are the bonds which have the smallest coupons. So if you don't care about tax in an ISA or a SIPP, well, it makes absolute sense to monetize that higher yield. You're not going to pay tax on these things anyway, capital gains or income tax. So the unpopularity of these bonds is to your benefit. There's no greater credit risk, there's no greater duration risk, so it makes absolute sense to go for the greatest yield. So if you do want to buy a single UK government bond, it's not easy to find out where you can buy them. So far I've discovered 4 UK platforms which offer single gilts, and these are Interactive Investor. I made a video about buying my gilts on Interactive Investor, and that was inside an ISA. So I bought a normal gilt and I also bought an inflation linked gilt. Other platforms include XO, which is execution only share dealing, also AJ Bell and Hargreaves Lansdown. So if you know of any other platforms, please leave me a note in the description. I'd love to know if there are others which offer gilts. And let's end on a word of warning about gilts. Now, these are not investments for the long term. Historically, over the last 100 years or so, gilts have returned about 4% less than stocks, and that means that every pound you put into gilts on average will earn less. So certainly if you've got money which will be set aside for 10 years, 15 years, 20 years, the vast majority of that should be in equity if you do need that higher return, which most of us do. But for the examples which we talked about at the beginning of this video, I think there's a pretty strong case now for buying gilts and making them part of your portfolio. Now don't forget, if you do want to use our special tracker, which lets you look at the yield curve on any day, and which updates all the time, then you just need to join our membership, and you can do that by going to our website, PensionCraft.com. And as always, thank you for listening.